is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. UBS shares fall despite the bank pulling in $28 billion in the months before the takeover of Credit Suisse. The chief executive, Sergio Ermotti, tells us the lender's share buybacks are temporarily suspended and not cancelled. Santander also trading lower as deposit outflows overshadow a profit beat. The CFO tells Bloomberg the bank is actually on target to meet its 2023 goals. Plus, LVMH becomes the first European company to reach a market cap of $500 billion thanks to booming luxury sales in China and the strengthening euro. Now, let's check in on the markets. A bit of pressure actually across the board. We have many earnings. Now, the big ones to watch out for in the U.S., Microsoft and Alphabet. In the meantime, we're seeing a bit of pressure. European stocks down 0.5%. Partly, it is companies that actually missed earnings. And there's also a lot of concern about geopolitics, what happens between China and Taiwan, as we also have, for example, the German Chancellor Olaf Scholz trying to assuage some of the tensions with China and asking for the meeting. Now, UBS did miss estimates for profit. That's according to first quarter results. The bank did attract $28 billion. So we'll see how the share price evolves throughout the day. The U.S. 10-year yield, as we look into quite a lot of data coming out of the U.S. Thursday and Friday, currently at 3.45 to 3. Now, in terms of the European map, one of our biggest stories. Now, we know that Bernard Arnault, of course, the founder and chief executive officer of LVMH, is the world's richest man. What was a surprise yesterday is that despite some of the good news already put in there, the CAC 40 has now the biggest valuation in terms of a European company. It surpassed $500 billion for the first time ever for a European company. That's LVMH. The CAC 40 today down 0.7%. Now, UBS has pulled its $28 billion from wealthy clients in the months leading up to its takeover of Credit Suisse. It is a pretty bright spot for UBS, which actually missed profit estimates for the first quarter. Well, our Manus Crowley spoke to the chief executive, Sergio Ermotti, earlier.
At times of distress in the market, generally the first quarter was very challenging. We still saw clients looking at UBS as a safe haven, and the inflows were coming in from all regions and from different sources. And in that sense, we are very pleased that particularly also after the announcement of the transaction of the acquisition of Credit Suisse, we still saw inflows coming into our bank. So a sign of confidence of our clients.
For 9 years, we sat together and we talked about dividend buyback, dividend buyback, dividend buyback. Here we are. We're in a pause mode. People are saying to me 2026 before it restarts. Is that a reasonable guidance to the market today that it's 2026 before you can smell a buyback restart?
It's too early to talk about buyback. I think what is important is to say that we pause it and we haven't canceled it. So our intention, as soon as we have more visibility about all the numbers and our plans, we will have also a better view on our capital return strategy. At this time, we are reiterating our intention to have a progressive cash dividend increase every year. And we are definitely have an intention to resume share buyback when it's appropriate.
The chairman guided us at a number of times that the integration would take 3 to 4 years. Is that a low ball and a low bar? Or again, is that a reasonable guidance?
I think it's reasonable guidance. I mean, this is a complex transaction. I think that, but it's also a transaction that will offer a huge opportunity, not only to our shareholders, but also to our clients. The two franchises are extremely complementary, and in many areas, and also to our employees. But in order to fully execute a transaction of this complexity, it takes time. And we have to do the things in the right way. We should not hurry into doing things that, and just for the sake of closing the transaction in a couple of years earlier.
Again, what kind of milestone do you have? You've thought about this. You've thought about this deal for many years. You, Axel Weber. What is the milestone in your mind that says I'm really succeeding in this integration?
Well, for me, is more emotional than numerical. I would say that in 3 to 4 years' time, I like to see the employees of the combined organization, this country, our clients, to be very proud to be associated with the new UBS.
There is a lot of social and political angst out there on Bahnhofstrasse and around over the Swiss Universal Bank. Lots of people come and say they're going to have to give up a piece of the Swiss Universal Bank. He's going to have to IPO to appease the people out there. Again, your response to that kind of speculation?
I'm glad you met some of them. I mean, it looks like we have a lot of experts nowadays on how to run banks in Switzerland. So I think that the only thing I can say is that we will take our time to make decisions based on facts and not based on emotions. And I'm sure it's going to be a good transactions.
Downsizing these combined institutions is going to involve, as you said, reducing risk-weighted assets, but it's also going to be a social cost in terms of job losses. How quickly will that pain be felt across the group in your initial estimate at this juncture?
This is by far the most painful part of the job, but I'm confident that we will do that, first of all, with full respect of the people involved, fair and as transparent as possible. Having said that, you know that we are, particularly here in Switzerland, is a pretty aging population. A lot of people are retiring in the next few years, and I'm pretty sure that we will be able, through that and also through natural attrition, to mitigate at least the social cost.
Tell me this, we're back in the banking hall. Are you back in your old office?
Yes.
How does that feel?
Good feeling. I think I was very honored but humbled about this new task I have, and the feeling is good, but also there is a clear sense of responsibility to make sure that this thing goes in the right direction.
Well, that was Sergio Ermotti, the Chief Executive Officer of UBS, speaking to our Manus Krani earlier this morning. Now, Manus joins us with the very latest. Manus, it was a wonderful conversation, very in-depth, and of course, he's still trying to figure out exactly what it looks like executing this massive deal. What were your key takeaways?
I think from the business point of view, they are as afflicted as everybody else. Down in transactions and net income that missed, they took a swipe and a provision for a legacy issue from 15 years ago. Transactions are down, net interest income is up, money's moving to money market funds. Those are the facts of the day. They are the affliction of banks at the moment around the world, Francine. But my take is this, why is the stock down 5% and bouncing at the moment? We're now back at a valuation on Credit Suisse. It's Bloomberg Mobile, by the way, everybody, Bloomberg Mobile. We're now back at a level which is before this transaction. They paid $3.3 billion for $54 billion of equity. This stock price does not reflect the Goliath that can become. And there's a fundamental disappointment this morning that the flow show didn't deliver a little bit more. Yes, $28 billion came in net new money. $7 billion of that we know in the 10 days after the transaction. Ermotti's back to me in terms of why did you not get more? Why are you disappointed? Was, well, it shows that there's great competition out there. So the flow show needs to go out into Europe and go, well, where did the other 61 billion of assets that went out the door from Credit Suisse go to if you only got 8?
Yeah, so Manus, first of all, Bloomberg Mobile, I mean, a lot of people couldn't actually be without it. Give us a sense of what happens next. So what did he say about the global banking landscape and how he will put these two banks together?
He was very guarded and very cautious. A couple of interesting things, though, I think. If you go back and sit and listen to what Ermotti said, we love this deal. I mean, you miss it. If you don't listen hard, you'd miss it. We love this deal. There's a reason why he loves this deal. But to integrate this bank, he made it clear demographics are going to play a big part. You asked about the Swiss Universal Bank at the news conference that night when the marriage of disequals was created. And I asked him about how quickly can you integrate and downsize the investment bank. His response was, and the overall institution, which demographics here are going to play a part, there will be a large part of attrition. So I can't forecast how many jobs are going to go. That's not what I'm here to do. But I can pick up the nuance of the language from the CEO, where he's talking about Switzerland, the demographics, the aging population, attrition, and people who naturally leave the institution will be a part of the narrative from Ermotti. He was humbled to return to his old office, but my gosh, he was frustrated with those new sages of banking on how to turn around the Swiss Universal Bank. That was a sense of frustration I felt.
Manus, thank you so much. As always, great interview. A lot of people are very happy to have Sergio Ermotti back, not only to run the bank, but also for your interviews with him. Central banks, this is breaking news. Central banks will revert from a daily to a weekly 7-day maturity operations. Now, what that means, does it mean that actually they're seeing less liquidity concern, or that the pipeline affords them to be a little bit less on the money day by day? For the moment, unclear why this decision was taken, but that Bloomberg red hot sticky, which is what we call our most important breaking news, central banks will revert from a daily to a weekly 7-day maturity operation. Coming up, First Republic reports larger than expected deposit outflows. We'll look at what that means for the wider market and U.S. banking sector. That's next, and this is Bloomberg. The deposit flight at regional U.S. lender First Republic has reignited investor concerns over broader financial stability and what it means for monetary policy. Now, the bank reported worse than expected outflows, with deposits plunging 41% in the first quarter. Now, this broke with more than a week of industry earnings reports that had broadly reassured the markets. Now, joining us is Diana Moa, Chief Investment Officer at Long Biased Strategies at Kurzweil Asset Management. Diana, thank you so much for joining us. First of all, it's a real pleasure to see you in the studio. There's so much going on with central banks, exactly what they're trying to do. What do you worry about the most? So are we betting wrong of what the Fed does? And do you worry that there's something ugly in the economy around the corner?
Well, I think one of the things that's been interesting this year so far is just the resilience in the growth numbers that we're seeing both out of the US and out of Europe. It puts policymakers in a hard situation, because what we're starting to see feeding through is the lagged impacts of monetary policy. So you mentioned the First Republic earnings. I think, banking sector stress is becoming much more of a concern for markets going forward, and that's more of a forward-looking hit on growth going forward. Now, what worries me is policymakers are now stuck between a situation where inflation remains high, the economy is flagging amber, so we're no longer in a green, growth is great, you can keep hiking aggressively, but inflation expectations simply aren't coming down as fast as they'd hope, which puts the outlook for the second half of the year as potentially quite challenging for markets.
But Diana, overall, is there a second banking crisis around the corner? Is it because of digital mobile banking and we move things around, or is it just a simple fact that you go to 1% to 6% inflation and there's going to be pockets of the banking, the world that will get hit quite hard?
I think the latter. What we're seeing is the parts of the economy that were levered, those sorts of business models are getting challenged now. I wouldn't call it a broad-based banking crisis, because we saw earnings today. We've had earnings from UBS, Santander. We had the major U.S. banks reporting earnings over the last couple of weeks, and that still remains quite resilient. So I think it's more going to be pockets of distress in certain parts of the financial system, but not necessarily a massive banking crisis.
Do you worry more about Europe or the U.S.? Again, there's a couple of things. We talk a lot about U.S. commercial real estate in the U.S. and whether, if it's flagged enough, then you protect yourself.
I'd say in the short to medium term, I'm more concerned about the outlook in the U.S., not only just because of what we're seeing with the regional banks. As you mentioned, commercial real estate becomes an issue. Into the summer months, we'll be talking about the debt ceiling. So there's probably more potential headwinds in the near term in the U.S. than in Europe.
What else makes you nervous out there? I guess when you look at the things that are flagged, it's easier to take a position on them or unwind some of the positions that you've taken. Is there something else that could come, as a real difficulty? I don't know whether you look at geopolitics and you try and model what the various scenarios look like.
So we've been discussing this in the show for a number of years, Francine. The fact that this decoupling between US and China is a much more longer-term structural trend. I think that geopolitical aspect and the tensions ramping up over the last few months is something that definitely bears watching. Beyond just, US, Europe, China, what's going on both from a trade perspective but from a military perspective, when we broaden it out to emerging markets, I think there are pockets of concern in some of the distressed sovereign credits. We're not saying we'll see a broad-based EM crisis, but definitely in the high-yield part with some of those single B credits, if financial conditions should tighten, continue tightening in the months ahead, they might actually be in for a pretty tough, tough few months.
So these are specific countries, I guess, that you worry about, also maybe because of a lack of structural reforms.
Lack of structural reforms, high external debt and financing needs are ramping up over the next few months. So between 2023, 2024, I think you'll start to see a lot of maturities coming through. And so far, when you look across the high yield space in places like sub-Saharan Africa, not a single creditor has been able to come to markets over the last year or so. So access to markets still remains quite limited.
Diana, overall, I don't know how you deal with the U.S. debt ceiling, whether there is now, and we spoke to Mark Mobius, and he says, look, we've been here before. It's always been dealt with, even if we have a rocky couple of days. Is the U.S. political system different this time?
I don't think it's different. I think it is going to be quite volatile, and I see it more as a volatility event. Where the sequencing does matter. You can look through the vol and say, ultimately, the politicians will find a resolution. But between now and then, we have a few months where political headlines and headlines around the debt ceiling will definitely inject some volatility into markets.
What does that volatility look like? Or, you know, is it treasuries all over the place, or are there other parts of the markets that we should brace ourselves for?
I think predominantly the treasury market. We're already seeing some of that being priced in the very front end in the US build markets, where the inversion in the front end T-bills is quite telling that markets are assigning a little bit of premium going forward. We've seen the cost of insuring US debt, the CDS, actually rise. So again, I think it's going to be fairly contained to the US, but as we come closer to the deadline, you might see contagion spilling over to other parts of the market.
Diana, what happens to dollar in this kind of environment?
So dollar is caught between a rock and a hard place. I think when you look at the broad dollar, you may actually see it more range bound. But what's interesting is the dispersion that we're likely to see in the components of that basket. So I think the safe haven currencies such as the euro, which is actually outperforming the dollar the last few days, might actually look relatively more attractive than the dollar. For more risk proxy currencies, I think it's less clear-cut that they benefit from this.
Diana, thank you so much for joining us. As always, Diana Mohader-Kirkwald, Chief Investment Officer of Long Biased Strategies. Now, coming up, we'll get your stocks on the move, including luxury giant LVMH, which has hit a milestone of 500 billion euros market cap. That story is up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get your stocks on the move with Joe Easton from our Equities team. Joe, we have good stocks, we have so-so stocks, but one that's actually flying literally off the shelves, LVMH.
That's right, Fran. So LVMH did really well yesterday, pushed its market cap up above $500 billion. It was the first European company to achieve that feat. And that was largely due to yesterday's move in the euro, but also generally the company doing so well in terms of their Chinese sales, selling lots of fancy handbags, also over in the US doing pretty well as well. We're losing some of those gains today, down around 1.1% as we see on the screen here over in Paris. But the big thing coming up is we've got Gucci after the close of trading today. Kering, the parent company, will be reporting earnings based in Paris as well. And that could be the next driver for that stock. In terms of what else we're looking at, we've also got AB Foods. Now, for me, this is the big surprise of the day. That stock dropping, as we see, 6.4% in London. That's the worst performer on the FTSE 100. And reading into this statement, it's quite surprising. They're warning of people potentially cutting back on clothing, even in the lower end of the market. Primark is expected to be a bit more resilient, given it is priced at a lower price point, and therefore less likely to be hit during a recession. But this is really kind of hitting that trade today, and that's the worst performer in London. Also, we're looking at Nestlé. Now, the big trade in terms of the defensive place to put your money. Where's that going to be? Well, looks like it's in Kit Kats and pet food. So Nestlé today reporting really strong sales in both of those components, both in Europe and the US, a little bit softer in Asia. Coffee is actually slightly weak. Nespresso, George Clooney's favourite, that one not doing so well. But nonetheless, Nestlé's margins are holding up pretty strong. That one's up 1.7%, one of the best performers on the staple goods sector in Europe today.
Who's not drinking enough espressos? I want to know, Joe. I
Definitely
also
not
have
me.
me neither. I'm doing my fair share. I have a funny George Clooney story on espressos, but maybe that's for another time. Joe, thank you so much. As always, Joe Easton there with your stocks on the move. Overall, a couple of stories that we need to watch out for. So stocks are falling. U.S. futures also falling. If you look at the earnings, they keep on rolling in. Now, we look at the Swiss bank UBS dragging banks lower after results fell short of analyst expectations. Banco Santander also sliding as concerns over outflows outweigh the first quarter earnings beat. We have Swiss food producer Nestle still up, as Joe was saying. And then one story that actually we know, everybody knows that it's something that's close to our hearts, but Italy standing out to Moody's investors as the only country it covers that's at risk of losing its investment grade rating. That's according to the company. It said it just this morning, so we look at some of the premium risk maybe and the spread between Italy and Germany at 10-year yield that so far has been stable, but for how long? Coming up, we'll bring you more of our exclusive interview with the Santander Chief Financial Officer. He's Jose Garcia Cantera. That interview up next, and this is Bloomberg. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, UBS has pulled in $28 billion from wealthy clients in the months leading up to its takeover of Credit Suisse. It's a bright spot for UBS, which missed profit estimates for the first quarter. Shares trading lower this morning, and we spoke to the Chief Executive Officer earlier.
At times of distress in the market, generally the first quarter was very challenging. We still saw clients looking at UBS as a safe haven, and the inflows were coming in from all regions and from different sources. And in that sense, we are very pleased that particularly also after the announcement of the transaction, of the acquisition of Credit Suisse, we still saw inflows coming into our bank. So a sign of confidence of our clients.
Sergio Ermotti also saying he's confident that some past clients will return. In conversation with our Manus Krani, who joins us now from Zurich. Manus, we're off the day's lows. The share price is down now sub 3.5%. Why are they lower?
I would say it's probably down to this sort of slightly flat outlook on net interest income within the wealth management division, which is the largest, you know, the sort of the workout at the gym, the musculature of wealth management within UBS. Net interest income rose by 31%, but it's about the outlook going forward on lending and net interest income. I mean, what I would say, Francine, there's a lot of punting going on about why is it down 5%? Was it because of the lack of inflows from Credit Suisse and not a more defined aspect to that? You're right, $28 billion came in, $7 billion in the last 10 days of March after the deal closed. Look, I think the bottom line is maybe there was a hope for some stronger language around the buyback and the guidance. Two areas of guidance where I pushed Ermotti and got steady answers, which was, will you integrate it in 3 to 4 years? Is that a low bar? After the interview, he said, look, man, you know, people, when they put these big deals together, they take 2 months to put it together. They did this deal in 2 to 3 days or 5 days, depending on who you talk to. So they've got an awful lot of work to do post-mortem, not pre. That is the issue, Francine. A pause on the buyback, but it's not cancelled. And in terms of the other narratives that come through, I think there was just a hope for a little bit more robust guidance. But it's too early. This guy has sat into the chair as of the AGM that we were in Basel just over a couple of weeks ago, 2-3 weeks ago. So in terms of the ability to give material guidance on integration, on downsizing the bank, there are hints in that interview. But you have to go back and listen. Shameless darned plug. But it's 12 minutes of good listening. He loves the deal. Of course he does. And in terms of the flow show, don't forget, American banking was in a state of turmoil. So they got inflows from the US as well. I think there's a bit of disappointment that the flow show didn't say more about we got a gusher in from Credit Suisse. That was not the narrative.
It is a brilliant 12 minutes. Manus.
Take our time to make decisions based on facts and not based on emotions. And I'm sure it's going to be a good transactions.
Not to me.
So there you go. That's Ermotti. I think really sort of trying to sort of pull back the expectations. It is facts, not emotions, which will drive his decision in terms of how to reshape the investment bank, the time frame to do that, being conscious of the political nuances and the social nuances of Swiss society. It was quite interesting when I sort of said to him, look, yourself and Axel Weber, who you know well, Francine, you know them both very well, they've wargamed this. UBS have wargame taking out Credit Suisse on a number of occasions in the past. It's what you should do. You should be prepared for that Damascene moment. So there was a glint in his eye when we talked about that. But as he said to me, Manus, I will benchmark this as a success. Quite interesting. Emotion over finance. And that speaks solidly to his Swiss roots and to his gratitude and his humility to this country. That's what kept through at the end.
Yeah, and Manus, it's incredible when you speak to, so many analysts, they say, look, this is the deal of the century, but it's going to be painful. And also the chairman has said so himself, this is going to be painful to execute. You're running a bank, you're running a very large bank, you have to keep clients happy, whilst at the same time integrating Credit Suisse and deciding who to let go. So what did we learn about the Credit Suisse deal?
In terms of that process, again, going back to the chairman's comment at the AGM and beyond, 3 to 4 years is the integration timeline that's been put out there. Personally, having seen him in action before, downsize UBS, recreate the definition of what wealth management is and what the investment bank is to wealth management, that takes quite a long time. Typically in these processes, we will get big, high, blockbuster headline numbers when they come through with the strategy in terms of the number of jobs to go. However, here in Switzerland, the political and social angst is such, and he touched on this, a great deal of demographics will play into what happens with the Swiss Universal Bank and the Swiss business. People are getting older. There will be natural attrition, and to a large extent, that will help him on the journey, the painful journey of downsizing two gargantuan pieces of Swiss society, Swiss industry, and the fabric of this country. So that's going to be part of the story, which is attrition rather than a scythe that cuts through it. He's very, very aware of his social responsibility to Switzerland.
Manus, thank you so much. Our Manus Crani, they're outside, of course, UBS headquarters with a fantastic interview with Sergio Ermotti. Coming up, new data shows Britons flocking to discount grocers as food inflation remains stubbornly high. We'll have the details next, and this is Bloomberg.
The moment news breaks, no one covers the world like Bloomberg.
It would be, of course, a total disaster for Emmanuel Macron because he's been elected on this reform and he would have to basically start from scratch.
It definitely is an exciting day for Apple. First store in India, here in downtown Mumbai, a second one coming up in Delhi.
TK, we've got a lot to talk about.
Debt, China, and the shockingly cautious view the IMF has on the view 5 years forward.
Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, discount grocers are winning over more British shoppers as double-digit food price inflation cuts into household budgets. According to market research group Kantar, annual shop price inflation dipped slightly to just over 17% in the last 4-week period. Now, for more, let's bring in Bloomberg's UK correspondent, Lizzie Burden. Lizzie, it dipped, 17%. This is horrific. Break it down for us.
Yeah, it's the 10th month in a row that it's still in double digits, but yeah, it's kind of good news that it's dropping a bit. If you break it down, you can see that what's really rising are milk, eggs, cheese, the stuff that everybody has to buy. So that's painful for the poorest consumers. And you can see that what they're doing is going to own brand lines. Those sales went up 46% year on year. But you have to ask, where do they go from there when everything's inflating? And then if you look at what it means for the Bank of England, the Deputy Governor Dave Ramsden gave an interview to The Times on Friday. He said that he's especially concerned about food price inflation. He actually thinks that the risks of inflation outweigh the the risks of over-tightening even at this point. And you've got traders almost fully pricing a 5% peak for rates right now. But when I speak to economists, they say one of the reasons that they keep on underestimating inflation is because of the gap between CPI and PPI, and it's changed from previous crises. And they suggest that that's because companies are price gouging on food. Hence why perhaps you can see why policymakers continue to resort to this blunt tool of rate rises to control inflation.
What about public finances?
So we got the latest data from the Office for National Statistics at 7 a.m. They showed that the UK's Treasury ended the most recent fiscal year with a deficit £13.2 billion below the official forecast. That's despite the huge energy subsidies, it's despite the big spike in interest costs that you've seen. And interestingly, there was a note from KPMG saying that even though everywhere's having these problems, they estimate that a quarter of the rise in gilt yields over the past year is specifically because of UK-specific problems. But the reason for this deficit is because you've had buoyant tax revenues in the UK. We know that the tax burden here is the highest in the Second World War, the period since then, at a time when the economy isn't growing. So you're going to have a long line of Conservatives at the Chancellor's door asking him to spend this headroom on giveaways before the next election, especially when you had S&P on Friday upgrading its outlook for the UK. They'll say, look, things look rosy. We're well past the Liz Truss era here.
Lizzie, thank you so much. Lizzie Burden there with the very latest on the UK. Now let's get straight to the Bloomberg First Word News with Leanne Gerrans. Hi, Leanne.
Hi, Francine. China's looking to distance itself from remarks by its French envoy who questioned the independence of former Soviet states. The Chinese embassy in Paris says the comments by Liu Xie were a personal point of view. A foreign ministry spokesperson added that Beijing respects the status of ex-Soviet republics as sovereign countries. Now, the US says Sudan's two warring factions have agreed to a 3-day humanitarian ceasefire. Foreign governments have accelerated efforts to repatriate staff, with the UK Prime Minister Rishi Sunak saying the large-scale evacuation of British passport holders will take place on RAF flights. Now, shares in Fox closed down almost 3% after the company said it's parting ways with Tucker Carlson, its most popular primetime TV host. His departure comes after the network's $787 million settlement with Dominion Voting Systems. Fox will employ a series of rotating hosts in Carlson's 8 p.m. slot until a successor is named. Meanwhile, CNN anchor Don Lemon says he's been fired from the network. Lemon was previously taken off air for comments about Republican presidential candidate Nikki Haley. The UK government is set to unveil new legislation that could lead to a crackdown on Silicon Valley. But tech firms such as Google and Meta platforms face more oversight and fines of up to 10% of global sales for practices that do hurt consumers. The legislation adds a new digital markets unit within the UK's antitrust regulator. First Republic Bank plunged in US late trading after quarterly earnings reignited investor concerns about prospects for its business. Results included a worse than expected drop in deposits, tumbling more than 40%. First Republic says it will cut as much as a quarter of its workforce, lower outstanding loan balances and curb other non-essential activities. The president of the Confederation of British Industry says the lobby group may not survive a scandal triggered by multiple allegations of sexual assault and harassment among staff. In an open letter to members, Brian McBride said he hoped the CBI, the UK's biggest business group, could return as a reformed organisation, quote, whether or not that is actually possible. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, Santander shares are lower this morning as a drop in earnings from Brazil and deposit outflows from Spain troubled investors. Now, that's despite tailwinds from rate hikes that actually helped the bank turn in its best results since 2009. Well, we spoke exclusively to the Chief Financial Officer, Jose Garcia Cantera.
We've grown 9 million customers in the last 12 months, and we have increased volumes and both in loans and deposits. So obviously higher rates, particularly in Europe, is a good tailwind, but I think our model is working very, very well. We are adding customers, and that is, good for profitability. We grew revenue at double digits with net interest income growing 15%. And our efficiency ratio was 44%, so a very strong set of numbers.
Well, that was Jose Garcia Cantera, the Santander Chief Financial Officer, speaking to us exclusively a bit earlier. Now, coming up, there might be trouble for Dubai's once coveted expats. We discuss the latest on the Emirates' luxury housing boom with the Minister for the Economy, Abdullah Bintouk Al Mari. That interview is next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, a new influx of wealthy Russians, bankers, and crypto millionaires to Dubai is pushing up rental prices in an already expensive city. Now, that's pricing out expats and raising questions about how the city will stay competitive. I'm very pleased to welcome the UAE Minister for the Economy, Abdullah Bintouk Al Mari. Minister, thank you so much for joining us. Now, your growth rate is also the stuff of envy of many economies around the world, but how do you manage the influx of people in trying to also remain, I guess, affordable and attractive for expats?
So the UAE has always been a place where looks for the region and scale-up nation, where people look at the UAE to scale up their businesses, their trade, and the UAE has always been a trade hub for the last couple of decades. Yeah. I think the important aspect today in our economy, we are expected to grow to 7.6% in our GDP last year. The World Bank and international organizations are reckoning that we're going to grow about from 3 to 4%. This year, we are one of the fastest economy of recovery after the pandemic. And as well, we're looking at as well a lot of structural reform in our policies and regulations in the economy to allow to reduce a lot of red tapes and a lot of challenges in opening businesses. One of which is the important one was the 100% company law. Yes. That we amended back in 2020. Today we have 275,000 new business licenses. Yeah. Which is incredible. Which is huge.
Minister, do you feel sometimes like you're walking on a tightrope? So you have the corporate tax, which is coming in July, which is 9%. I want to ask you about that. But you're growing at 7%, and you're also needing to basically adjust it or making tweaks to make sure that people still want to leave there comfortably. What's your biggest challenge?
So the corporate taxes really actually will add up to the economy, because at the end of the day, it's corporate tax on profits. Yeah. So if a company is really doing profit and the economy is growing, there's where 9% will be. And 9% actually is one of the lowest corporate tax in the world. And I think this will actually, the movement of companies and the expansion of companies doesn't really depend on the corporate tax, because if you're doing profit and businesses, the growth actually expands.
Minister, who does it touch? So I know there's been a bit of a backlash from certain Emiratis. Are there people that will be exempt from the corporate tax?
Yes. Now the bylaws and the bar regulations are coming out. They're going to be coming out from now to the next couple of months. More details of it will actually be explained. There are some now which is exempted, such as the government entities, for instance, are exempted. There are a couple of other as well stakeholders are exempted, and more details are going to come up in the next couple. So the UAE, when they adopted the corporate tax, they're going to adapt. We're going to adopt the corporate tax on a high standard, a global standard as well. We're not going to reinvent something new, and I think this is something which want to assure the private sector, want to assure the companies in the world that the UAE will not bring something which is not out of the norm.
Does an income tax come next?
Well, that's income tax not on the table at the moment. But what we are at the moment looking at is the corporate tax and how we're actually going to implement it.
Minister, I mean, the other big question is, of course, when will the UAE leave the FTF's grey list that you've been adding over a year? And you've so far, this is about dirty money, and so far you've said, look, we've done all of this to make sure that we're compliant to some of these standards. What's the biggest tackle ahead?
So the UAE has been on the grey list for the last couple of years. We had 58 action items. And to tell that we have reduced that to 15 action items. Okay. Now, the FATF has put the UAE on an agenda plan where we need to action plan to actually reduce these action items. We'll be submitting our reports quarterly. We've been assessed quarterly. The last submission of our report was back in March. We're going to be assessed again in May. The last one before that was actually in November. And we were assessed in January. So there is an action plan for the UAE submission, evidence-based reporting, and more take down the 15 action items that's left.
Minister, when do you think you'll get out of it? This year, next year?
Well, this is a question to the FATF, right? They have a process of going through. We can't expedite the FATF process, but what we can do is providing our reports and evidences.
What do you think is the major thing to tackle, actually, to get off that list?
Well, the effectiveness of the implementation. So the UAE really shows as well in any reports you read for the FATF that the UAE have come a long way. We provided a lot of our policies, our regulations, but effectiveness means that you need to enforce fines and so forth, but that will only come during time. So we are showing there's a lot of fines coming out. There's a lot of implementation and effectiveness of the items, and these are the things that needs a little bit of time to really encompass and shows that the world that the UAE is effective in actually implementing these processes.
Minister, when we look at the Gulf states, certainly the UAE is the most diversified Gulf economy. What are the benefits of each business model? Like, how would you describe the UAE's benefits in the next 5 to 10 years?
So the UAE looks at its models differently. 50 years ago, we built our seaports. 20, 30 years ago, we focused on airports. Today, the UAE is a brain port where we attract and we modernized our attractive of talent, where we and improved our quality of life in the UAE. It's the #1 destination for the Arab region. To really Arab youth to look at the UAE as a destination for employment and growth. That's where we see the aspects of the UAE in many ways. So what keeps us as well, our UAE's leadership that's really closer to the nation, closer to the people, and really focuses on the models of the economy and how we can grow.
And Minister, what kind of discussions are you having with the government, for example, about COP28? What will be the fruitfall for that?
So the COP28 is the second time in the MENA region. The UAE invested in the climate change for the last 2 decades. And I think the importance at the moment as well, how the UAE can really bring the global leaders together to really emphasize the importance of decarbonizing economies, moving into more green transitions, and moving as well, and creating as well opportunities out of it.
Minister, thank you so much for your time today. That was, of course, the UAE Minister of the Economy, Abdullah bin Tuq Al Mari. Now, we'll have plenty more, of course, throughout the day, not only on markets, but certainly looking specifically at some of the banks. Now, we had a great interview with the UBS Chief Executive Officer, UBS actually dropping in terms of share price, after some of the wealth clients have been a lot more cautious as it embarks on the complex task of integrating Credit Suisse. That overshadowed $28 billion in new money from rich clients during the quarter. So we'll have plenty more on the banks. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller in New York, Anna Edwards in London, and this is Bloomberg.
We believe we're still in a bear market, a mixed market. We think we've seen the worst of it.
Overall, we have a situation where European equity markets had outperformed U.S. equity markets for the first time in a long time.
Now we're getting into the world where, okay, we're getting close to peak in Fed hiking cycle. We potentially, we're very likely going into recession. So let's look at companies, which companies can defend their margins better, can sustain some profitability or see less earnings decline. So it's really about earnings.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. A bright spot for UBS in an otherwise lackluster earnings report. The bank attracted $28 billion from wealthy clients in the months running up to and just after its takeover of Credit Suisse. Shares of First Republic are plunging today. Customer deposits at the beleaguered regional bank plummeted 41% in the first quarter. And big tech takes the spotlight today. We will get quarterly reports from Alphabet and Microsoft. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And as we heard at the top of the programme, it is really about earnings, Matt. And they haven't all been dire, but still, European stocks trade lower and US futures point downwards.
Yeah, US futures pointing down, although we continue to kind of ratchet up our levels on the S&P and the cash trade. So yesterday, for example, we were up just less than 0.1%, so we closed at 41.37 on the cash trade. Futures taking a little bit of that away. Now we're looking at futures drop of almost 0.6%, and investors are buying bonds. So pushing that yield down by more than 4 basis points. We're now trading at about 3.45 right now on the 10-year yield as investors look to seek a little bit of safety. We have oil creeping ever higher here. There are problems with supply out of Iraq, problems with supply out of Sudan, and that's offsetting the concerns about demand, which hasn't really showed up in the reopening of China. So oil steadily climbing back up towards $80 a barrel right now. NYMEX crude at 78.81. And then Bitcoin, it looks like a little bit more profit taking there. $27,412 is the level right now, so well under 28. In terms of what's happened in Asia overnight, if you look at the broader MSCI Asia Pacific Index, we had a drop there of about 0.6%, a bigger drop in Hong Kong, about 1.7%, but the Nikkei bucking the trend and also eking out some gains of about 0.1%. The U.S. dollar, a little bit of weakness against the yen, but I stress a little bit, not a lot of movement there. At 134, it's basically at the exact same level it was when we looked at it yesterday, Anna. So you've got weakness in Europe.
Yeah, weakness in Europe. Not a great deal in some markets, but actually quite divergent. More than 1% weaker on the IBEX, financials weighing down there, and the FTSE MIB over in Italy down by just over 1%. Losses of around 0.2% in Germany, in London as well on the FTSE 100. So a mixed picture across European markets, but everything, it seems, all of the geographies at least, are under pressure today. And not all of the earnings reports were bad, as I mentioned. In particular, if you're in food, beverage and tobacco, in healthcare, we had some better earnings reports there. More on that in a moment. Rio Tinto, though, this is I put this one in as an example of what we're seeing on the basic resource sector. This is an area where we are seeing weakness and is not an earnings story. Iron ore prices down for the 5th day in a row. Have some of the mills in China overstocked in the run-up to the Golden Week holiday? Seems to be one of the questions people are asking as we look at maybe lackluster demand for iron ore over in Germany, over in China, sorry. So that's weighing on the mining sector, which again then weighs on London. The UBS share price down by 2.6%. We mentioned in the headlines the way that they managed to attract some money from Credit Suisse and some money from elsewhere when it comes to the flow into wealth management. They disappointed on the bottom line, a big provision for litigation costs that go back, way back to the GFC. But that stock's down by 2.75%. We are live in Zurich, of course. We'll bring you more on that story with Manus Cranio in a moment. Banco Santander over in Spain, weighing on the whole Spanish sector. A concern perhaps around the Spanish business, also the Brazilian business. That detracted from the fact that the numbers actually looking backwards beat estimates, the higher interest rate environment certainly managing to take the business higher there ahead of estimates, and also they confirmed their guidance for in terms of return on tangible equity. And Nestle, this is a good earnings story this morning there, Matt, up by 1.5%. Overall, they managed to lift their prices, and sales unexpectedly for the whole business actually increased. Where are they in particular seeing pricing power? Apparently it has to do with pets. So if you have pets, apparently you don't really care what you spend on them, and that seems to help the bottom line over at Nestle.
That is very interesting. I mean, I think of them as, well, first and foremost, as a maker of Crunch, and secondly, powdered
Kit
liquid
Kats.
beverages, Kit Kats as well. But for me, Nestle Crunch is the OG. But it's really the beverage section where I thought they made the lion's share of their revenue. So interesting that they're pulling in the most profit from pets. Let's get back to banking, though, because we've got a lot of bank stories across Europe and here in the U.S. as well. In terms of UBS, that's where the focus, the most focus is. They pulled in $28 billion from wealthy clients in the months leading up to the takeover of Credit Suisse. It shouldn't have been difficult, right, as people were dumping money out of Credit Suisse by the bucket load. It's been a bright spot for UBS, though, in a quarter where it missed estimates and had the lowest profit in 3 years. Bloomberg's Manus Cranio spoke to the CEO, Sergio Ermotti, earlier.
at times of distress in the market. Generally, the first quarter was very challenging. We still saw clients looking at UBS as a safe haven, and the inflows were coming in from all regions and from different sources. And in that sense, we are very pleased that, particularly also after the announcement of the transaction of the acquisition of Credit Suisse, we still saw inflows coming into our bank. So a sign of confidence of our clients.
Manus Craney joins us now from Zurich. So, Manus, what was your key takeaway from UBS's earnings?
Matt, I like what you sort of said. It should have been an easy drop, shouldn't it? The 69 billion that walked out of Credit Suisse should have jumped on a tram, come up Bahnhofstrasse, and dropped into UBS. Bottom line is, I think the reason why you saw the stock tank by 5% this morning is they've got the same affliction as everybody else, going to cash, going to money markets. But here's the beat. $28 billion came in, $7 billion came in the last 10 days after the deal closed with Credit Suisse. Should have been more, should have been me. That's what's going through my head, that is the rationale of the market. They pushed back at attributing any massive influx from Credit Suisse, and Ermotti said it shows there's healthy competition on the street. It pushes back against this global narrative that it's too big, it's a monolith, and it's going to dominate everything. That sort of works in terms of pushing back. It demonstrates there's competition and that fear of concentration is off the table. But I think when you look under the hood, Anna, it is about that sheer issue for everybody. Going to money market funds, outlook for lending, maybe a little bit muted. So I think it's a cocktail of reasons. And a lot of people just sticking their finger in the air and going, I don't really know why it's down 5%, but I'll go with this.
Right, yeah, that's sometimes part of it, isn't it, Manus? In terms of that combination then with Credit Suisse,
yes.
What did we learn about that, around the timing, around the challenges ahead?
A very clear message. Q2, it closes. The regulators are on board. The PRA are there. The Fed are there. The Swiss approvals are coming. Very hesitant to say that there'll be any major obstacle. But, of course, when it comes to matters of grave importance, is it emotion or fact that drives the bus? Take a listen.
The only thing I can say is that we will take our time to make decisions based on facts and not based on emotions. And I'm sure it's going to be a good transactions.
And he did go on to sound a slight sense of frustration with some of those good buddies out on the street here who sort of say they're going to have to sell part of the Swiss Universal Bank at Credit Suisse. They're going to have to IPO that. They're going to have to assuage society. He said, there's a lot of new sort of gurus on how to run Swiss banking. He has a blueprint. It's called UBS. He spent 9 years putting it together. I think where the market is slightly disappointed, Anna and Matt, is that there just wasn't more of a robust, yeah, we'll get it done in less than 4 years. That's what the chairman said. Yes, Manus, buybacks will be on the trade well in advance of 2026. It wasn't. It was a very measured, a very steely, a very focused individual that I met this morning. Laser sharp focus on execution and taking their time. And there are jewels within the Credit Suisse crown that they do want to retain.
Right, and of course, as you point out, Sergio Ermotti has a track record. He's been there, he's done this, and it looks like he wants to do it again, or he's prepared to do it again. Manus Craney, thank you very much for your reporting on the ground in Zurich. Now let's get to the U.S. Story. Smaller banks, regional banks, First Republic, falling in pre-market trading by a lot more than UBS, like 4 times more in percentage terms. The bank's quarterly results reignited investor concerns about the prospects for that particular business, with customer deposits plummeting 41% in the first 3 months of the year. And that doesn't even account, or it takes into account the additional $30 billion that JP Morgan & Co. Put in. President and CEO Mike Roffler spoke on the earnings call.
We are pursuing strategic options to expedite our progress while reinforcing our capital position. I also want to underscore the key aspects of our business that will remain unchanged. These include operating a simple and straightforward business model focused on delivering exceptional client service, working collaboratively to meet the banking and wealth management needs of our clients.
Bloomberg's Tom Metcalf joins us now for more. And Tom, you know, the 41% deposit drop, that includes the $30 billion that Jamie Dimon and Brian Moynihan and other big banks put in there. If you take out that $30 billion, it's more like a 60% drop in deposits.
Yeah, no, exactly. And I think for me, that's the staggering statistic here, right? Like they went from about 170 billion right the way down to 100 billion. And of course, in that time, you had 30 billion coming in from various banks. So, you know, that is what the market's really seizing on. You can see the shares down 22%, I think it's the latest. And that is what people are worried about because as we've seen with other banks, you know, once you start losing deposits, it, you know, really just sort of feeds on itself.
Yeah, a whole new conversation in the digital world, isn't it, Tom, about the speed at which deposits can go out the door. So where does this leave First Republic? Where does it go from here?
Well, yeah, exactly. There's a lot of talk. Has this sort of reignited those investor fears? You know, will there be more concern about its sort of future as an independent bank? I mean, what I thought was interesting, we just heard from the earnings call, the executives did not take questions. So they just basically read out a statement and then, you know, I think it was all wrapped up within 15 minutes. So, you know, I think what these results have done is just ladle on more questions, and it doesn't seem executives are willing to answer them yet.
All right, Tom, thanks very much for that coverage. Yeah, I think it was interesting that they held just a 15-minute conference call and then took no Q&A, which is terribly unusual in an earnings call, even for First Republic. So they look like there are endemic problems there. Let's get to the big story across America yesterday. Fox News is parting ways with Tucker Carlson, its most popular primetime host, who is also the source of repeated controversies over his statements on everything from election fairness to race to LGBT rights. Let's get to Bloomberg's Bruce Einhorn for more. Bruce, what do we know right now about the firing of this host who, you know, regardless of your thoughts on his politics, he brought in 3.3 million viewers a night?
Yes, he had the most popular show on cable TV in prime time other than sports. As far as the reasons for the departure, we don't really have very much. We have the announcement on Fox News that they had parted ways. Beyond that, there's nothing else from Fox explaining why. No comments from Carlson at the moment. Of course, this does come less than a week after Fox agreed to settle the defamation case brought by Dominion Voting Systems for $787.5 million. As part of the discovery in that case, evidence came out of Carlson making insulting comments about others at Fox News. Carlson is also subject to a lawsuit brought by a former Fox News producer who's alleged a culture of misogyny and a hostile workplace at Fox. So whether any of those things had something to do with his role, we're not sure. We do know, according to a person familiar, that Lachlan Murdoch, the CEO of Fox Corp, and Suzanne Scott, the CEO of Fox News, made the decision on Friday to get rid of Carlson, and he got the news, and there was no further show for him on Monday.
Yeah. So what's the impact on Fox then in terms of this latest announcement? And given his influence, could this affect the 2024 election, or at least change the role that Fox News plays in it?
Well, we did see an immediate reaction from investors. At one point, the stock price was down more than 5%. It did recover, but it was still down about 3% for the day, an indication that investors may be concerned that without Carlson, Fox will struggle to keep some of its audience. Carlson, very influential in Republican politics, just recently had an interview with former President Trump. So it's unclear where he'll be going next. If he does go to a rival network, that could peel viewers away from Fox. On the other hand, keep in mind that Fox News has lost high-profile people in the past, most notably Bill O'Reilly years ago, and has remained as influential as ever. So whether the same thing would happen again with Tucker Carlson's departure, we will have to see.
Bruce, thanks very much. Thanks for the update. Bloomberg's Bruce Einhorn on the way that media story plays in to politics. Coming up on the programme, we'll get back to the markets. Ann-Katrin Petersen, BlackRock Investment Institute Senior Investment Strategist, joins us. What's the emerging market strategy? How much slowdown in the United States can EM assets tolerate? We'll also talk banks. It's been a really busy day for European bank earnings. Filippo Alloatti joins us, Federated Hermes Head of Financials for Credit, as European bank earnings rolled in this morning. Lots to digest then with him. Earlier on Bloomberg, we heard from Santander CFO following the bank's results. He shared this outlook.
We've grown 9 million customers in the last 12 months, and we have increased volumes and both in loans and deposits. So obviously higher rates, particularly in Europe, is a good tailwind. But I think our model is working very, very well. We are adding customers, and that is, good for profitability. We grew revenue at double digits with net interest income growing 15%. And our efficiency ratio was 44%, so a very strong set of numbers.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York with Anna Edwards over in London. Right now, I want to talk about European stocks and where we are in terms of the gains that we've seen, how much further we could go. This chart lays out neatly the highest forecast, which we're approaching at about 480 on the Stock 600. We're well above the average forecast of 450, but with the ECB continuing to tighten policy and with the slowdown in growth that could affect, are we going to see European stocks climb any further? Joining us right now is our equities reporter, Michael Masika, out of London. So, Michael, what do you think? Is it possible for European stocks to climb further, or is it time for them to top out and roll over?
Well, according to the strategies that we see, Matt, this is not going to go very well for European stocks. This is like getting very toppy. Like you said, the highest forecast is 480, which is unusual in our survey. Usually the highest forecast is way higher than the current level. So we can tell that the optimism is definitely abating.
Optimism abates, and JP Morgan and Bank of America, I know that you quote talking about the risks that European stocks face after this incredible long rally up. We've seen that with luxury stocks, certainly with LVMH, for example, challenging for the number 9 spot in terms of listed market cap. So there are some sceptical voices about whether this carries on. Do we go into a higher volatility environment around European stocks as a result?
Yes, exactly. I mean, you can see volatility has been quite contained over the past month, especially surprisingly after what happened with the banks in America and with Credit Suisse. But things could go slightly pear-shaped from here. I mean, volatility is set to rise, first of all, because some of the effects that we had over the past month are going to be fading, like the quantitative easing from the Fed after the bank failure. But also the Chinese reopening is already showing some sign of softening. European economic data is softening. The manufacturing data has been quite bad, and the rest, all the economic surprises in Europe are fading as well.
What about earnings, Michael? I mean, here we've seen earnings beat, but of course, actual profits are lower than they were in the same quarter last year. How is the European earnings season shaping up?
So pretty similar. I mean, the first few earnings that we had were okay, but you have to remember that analysts have cut forecasts dramatically ahead of the earnings season. So that makes the comparable very, very easy to beat. And so that's why we're having a lot of good surprises in Europe. And for a lot of strategists, this is probably the end of the earning beats. And from here, this is going to be much more difficult.
This is where Matt points out that he's never surprised when he sees the earning beats, because he's become used to it after many, many years at Bloomberg and tracking them on the Bloomberg terminal. Thank you very much, Michael. Thanks for bringing us to your conversation. Bloomberg's Michael Masika with the latest on equities, in particular in Europe versus the US. For more market analysis, check out MLIV Go. That's the function to use on the Bloomberg terminal to find the market's live blog. This is Bloomberg.
Now, keeping you up to date with news from around the world, here's the first word. In Sudan, the war sides battling for control of the North African nation have agreed to a ceasefire. The Sudanese army and the rival Rapid Support Forces are backing a 72-hour humanitarian truce. The army says it was brought about by U.S. and Saudi mediation. Chinese President Xi Jinping's efforts to portray his country as a peacemaker in the Ukraine war have been undermined. Now Beijing is trying to extinguish a firestorm caused by its ambassador to France, Liu She, questioned the independence of the former Soviet states, echoing Vladimir Putin's views. Beijing said that was a personal point of view and reaffirmed respect for the sovereignty of countries that were once part of the Soviet Union. Coming up, Ann-Katrin Petersen, BlackRock Investment Institute Senior Investment Strategist. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A bright spot for UBS in an otherwise lackluster earnings report. The bank attracted $28 billion from wealthy clients in the months running up to and just after its takeover of Credit Suisse. Shares of First Republic are plunging today. Customer deposits at the beleaguered regional bank plummeted 41% in the first quarter. And big tech takes the spotlight today. We will get quarterly reports from Alphabet and from Microsoft. I'm Anna Edwards in London with Matt Miller in New York, and it's earnings here. A focus on banks, financial services, Matt, for European equities, and indeed with the US news out of First Republic last night. But you're looking ahead to more earnings reports with a tech flavour to them a little later.
Yeah, we've got Microsoft and Alphabet coming out today. Speaking of flavour, we have Pepsi coming out in just a little bit as well. So there are a lot of big consumer companies yet to come out with earnings, as well as the mega tech, communication services, whatever you want to call it, those giant market cap companies that have just driven the market higher year to date. We are seeing a bit of a pullback in S&P futures right now, off about 0.5%, but we continue to steadily climb higher in terms of the cash trade. 41.37 was where the S&P closed at the end of trade yesterday. We do see investors buying bonds right now, maybe a sign that they're seeking some sort of safety as we get deeper into earnings, and then we don't really have big market moving eco data until the employment cost index comes out on Friday. Nonetheless, the yield coming down on the 10-year now to below 344 at 343.72. NYMEX crude has been slowly climbing up over the past couple of days. Yes, it's down 32 cents in the session today, but it's come back up closer to 80. Right now it's 78.44 on concerns about supply issues in Iraq and supply issues in Sudan. And those concerns have been outweighing the problem with demand that just hasn't appeared in China. So we're getting closer to 80, but coming off a little bit this morning. We could see that move throughout the day. And by the way, Javier Blas has an excellent big take on oil on the U.S. shale push, where they can finally make money down there in the southwest of the United States of America. Bitcoin is off a little bit as investors take some profits, 27,328. In terms of pre-market movers, First Republic is obviously a huge one. You can see in the pre-market down by more than a fifth after it said that deposits shrank by $72 billion in the first quarter, even after Wall Street's largest lenders parked $30 billion with the regional bank to shore up its finances. So really, deposits shrank by $100 billion and change, almost 60%. But fortunately, some of the big Wall Street banks put their money in there for at least a few months. Also, in terms of M&A, we have a great story on Getty. An investment fund called Trillium has made an unsolicited proposal to buy Getty Images, although the firm has been pushing for a sale of Getty for a while. A sale at, I think, $12. They've made an unsolicited offer at $10, I think, to try and goose the owners of Getty Images, who are, for the most part, the Getty family, right? But very interesting that stock had bounced up close to the $10 offer and has now dropped down in the pre-market. So investors don't believe anything is going to get done there. And then finally, Range Resources reported adjusted earnings per share for the first quarter that was better than the average analyst estimate. And this is one of those energy companies that's rising in today's pre-market trade. Right now up almost 5%, and we'll watch it at the open in just about 4 hours' time. Anna, what do you see going on in Europe?
Yeah, well, 2.5 hours into the trading day here in Europe, Matt, we see European stocks are down. On the upside, you've got food, beverage and tobacco and healthcare. We've seen some reassuring earnings stories coming out of those sectors, and those sectors not doing too bad. But at the other end, financial services and banks really under pressure. Also basic resources, 5 days of drops in the iron ore price, really putting the focus on China and the resilience there, or the extent to which the rebound is done. And we can see further rebound there post-COVID. So this is what we see overall, down by 0.5% on the stock 600 right now. This is the financial services pressure I mentioned. We've got UBS Group down by 2.5%. Yes, there were wealth management benefits from the demise of Credit Suisse in the sense that some of the flows came their way. Some seem disappointed, though, that UBS didn't get more of those flows. So that's part of the conversation. Or there's disappointments around the first quarter net profit line, where they had to take a big provision linked to litigation costs that go back right back to the great financial crisis. So the focus with a very long lens of history on UBS today. But that's where the share price is right now, this moment. Here's the bank sector going weaker. Banco Santander down by 3.8%. The stock under pressure on the back of disappointment around the Spanish business and the Brazilian business, even though overall the company managed to come in with numbers much better than expected. Higher interest rates clearly playing to their strengths there. And I should say the stock is off earlier lows. It was down by more than that earlier on. And Nestle, overall, they managed to please with what they reported today. They were able to put up prices, it seems, and actually sales went higher in a period where many people thought that sales would not go higher. But it seems that we still see a business here with pricing power, in particular around the pet food space, Matt, where they seem to be able to push up the prices of those pet foods.
Yeah, you can charge anything you want, right? People will pay anything for their pets. Let's get to more of a macro look right now, though, at markets, at least to start with Ann-Katrin Petersen over at BlackRock Investment Institute. She is a senior investment strategist. And just in terms of, where stocks are, Ann-Katrin, globally, and good morning. Thank you for joining us.
Good morning.
We've been talking about what looks like a pretty toppy market in terms of the stock 600 in Europe. And, of course, here in the U.S., we're trading at the tightest range this month that we've seen since 2017. So stocks doing a whole lot of nothing after gaining about 8% year to date. What do you think about developed markets?
Well, I think generally the past few months have shown that this remains a demanding environment for investors, also for equity investors. And this confirms our view that we do live in a more volatile macro and market regime. And concerning the equity market outlook, top of my mind currently, of course, is the earnings seasons as well as upcoming central bank meetings. And as a matter of fact, when turning to the US, the earnings expectations for this calendar year have been downgraded meaningfully. However, they do still look too rosy in light of slowing growth, in light of a recession foretold in the second half of this year. When digging deeper into consensus expectations, consensus is expecting a re-acceleration of earnings growth in the second half. And this may be tough in an environment where a recession hits. When looking into history of the S&P 500, earnings per share, for example, there hasn't been a time where earnings per share did not contract, even in an environment, and I know Anna talked about sales growth being relatively high, even in an environment of high inflation, hence high nominal GDP growth. So in that sense, equity markets do remain vulnerable to setbacks and to volatility as we head further into this year, in my view.
Yeah, so, I mean, in terms of the S&P 500, last year we were looking at $219, $220, right? And we have seen sales growth so far this quarter to that point, 7.2%, but earnings contracted by 1.5% in the first quarter. What are you looking for this year, Ann-Katrin? Like ballpark figure, how much is the tightening cycle that we've seen and the slowdown in the economy going to take out of earnings for the S&P 500 this year?
think that the earnings outlook and also generally the US equity outlook, also in terms of valuation, does not yet reflect the economic damage that is inflicted upon the US economy and US earnings by the US Federal Reserve tightening cycle. This is not yet priced. And unless we get to a situation where we think that this economic damage is priced, we keep a more cautious stance on US equities for the time being. Now, in terms of numbers, the consensus growth for the calendar year is around 0, so a flat growth. I think this is still on the optimistic side for the full calendar year for the US and actually also for Europe, where we do, their consensus expect modest positive earnings growth for the full calendar year 2023.
Ann-Katrin, good morning. Talking of the US and the earnings story there, I should focus perhaps on tech because we'll get the start of the tech earnings story really coming through today. Last time around, the focus was really on cost cutting and a focus on management that were really taking cost cutting seriously, and if an era of efficiency, I suppose, was much hailed. What do you think the focus will be this time around?
Well, this revamping of business model is generally helpful for the more medium-term earnings and growth outlook in the tech sector. However, what will be crucial again for the outlook in tech is the rate expectations. And currently, markets are pricing in swift rate cuts by the US Fed for the second half of this year. We do not agree. We do not think that a pause in rate hikes in the US, which will be nearing, means a pivot in the US Fed's policy stance. The Fed won't come to the rescue in light of still stubborn and still sticky inflation amid resilient labor markets. And as we all know, tech is a very interest rate sensitive sector. So the tech sector might have to digest this potential for a reversal in Fed rate hike expectations for the second half of this year.
Okay, so we'll watch expectations around the Fed then when it comes to the tech sector. What about emerging markets? Because, Ann-Katrin, a lot of people talk about opportunities in emerging markets. I wonder how resilient the EM narrative would be if we saw substantial slowdown in the US, or how resilient is EM with just a very shallow slowdown in the US?
That's an interesting point. Thanks, Anna, for that question. So we have actually upgraded our view on emerging market assets earlier this year. And one of the reasons for this upgrade is that emerging markets will benefit from China's powerful economic restart in the near term, which looks set to boost emerging market earnings, particularly in Asia, while Latin America continues to benefit from the demand for commodities. But there's other reasons why we do prefer emerging market equities over developed market equities right now. Apart from diverging earnings trends, it's a diverging central bank policy. Emerging markets have been started to hike rates about 1 year earlier than their developed market peers, and they are also look closer to pausing rates and perhaps cutting rates compared to the Fed and the ECB. And a third reason is the softer US dollar that we do foresee this year. All of these factors look likely to support emerging market assets, at least in the near term. So we have a tactical preference over the next 6 to 12 months.
Okay, really interesting on the EM story there. Ann-Katrin, thank you very much. Ann-Katrin Petersen of the BlackRock Investment Institute. Coming up on the programme, we've had a lot of bank and financial services reporting this morning. Here in Europe, we'll get to Filippo Alloatti, Federated Hermes Head of Financials for Credit. He can talk us through his thinking this morning. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Paul Jacobson, General Motors CFO. That's at 7:45 a.m. in New York, 12:45 p.m. London time. This is Bloomberg.
It's too early to talk about buyback. I think what is important is to say that we pause it and we haven't canceled it. So our intention, as soon as we have more visibility about all the numbers and our plans, we will have also a better view on our capital return strategy. At this time, we are reiterating our intention to have a progressive cash dividends increase every year. And we are definitely have an intention to resume share buyback when it's appropriate.
That was the UBS CEO Sergio Ermotti speaking to Manus Cranny earlier on today for the first time since the deal with Credit Suisse was announced. Now, shares in UBS are following the, well, they're lower, in fact, this morning, down in European trade by 1.7%. In fact, the Swiss lender is warning that wealthy clients are turning increasingly risk-averse and reports its weakest quarterly profit in more than 3 years. For more, we're joined by Filippo Alloatti, who is head of financials for credit at Federated Hermes. Filippo, nice to have you with us. Let's start our conversation then on UBS. So they've attracted wealth management money. That's the good side, and they continued, and they actually attracted some of that after the news that they were buying Credit Suisse. So that seems like a positive. But not all of the money that left Credit Suisse came over to UBS. Which for some is disappointing. How do you look at the wealth management numbers?
Yeah, I understand that's the disappointment on the market with the outlook, because I mean, when people, especially the wealth management client or UBS, take on less risk, then of course that affects the P&L of the bank. Having said that, I think there is I think the results are a little bit of a sideshow. I think the most important thing is, of course, is the integration of Credit Suisse, and I take comfort in the management. They say they expect the legal merger to be completed by the end of Q2, and I think in terms of the deposit flow, because there is as always very focused in this moment on deposit flow, I think that we need to remember that UBS and Credit Suisse are two of the largest wealth management franchises in the world, so there is an element of overexposure of some of the clients. So yes, so they benefit UBS from some of the outflow from Credit Suisse, but at the same time, some of the UBS clients, they already had deposit with Credit Suisse, so they can't just hold twice the deposit at the combined groups. I think also there is a mechanical element of this to be taken into account.
Yeah, he kept talking a lot about the complementary nature of the deal, the way he likes the deal because of that, also the financials around it perhaps, but talking about how the two businesses are complementary in his view. What are the biggest challenges do you think then, Filippo? Because this is going to take, according to the chairman, 4 years to deliver.
Yes, I think the execution risk is still very big. I mean, we know that essentially there is no plan B, because that's what they will have to do and that. And I think also, in my opinion, so they will consume a lot of management times for the next 3 years. And there is complementarity. I think also they get in Credit Suisse for very little, if not zero. And I think also they have a very big buffer to absorb all these restructuring costs. But I think also the management time will be 100% focused on integrating the Credit Suisse business.
In terms of the shares, Filippo, UBS today is trading just a little more than it was at the beginning of the year, and just about the same level it was at the beginning of last year. Did they get a deal? Did they get a great deal on this Credit Suisse purchase? And if so, why aren't investors valuing them at a higher level?
Yeah, that's a good question, Matt, because I think also will take some time to, there is still some missing details, but I think over time, and time will only tell, I think also they will demonstrate actually they got quite a good deal, and I think it doesn't really happen very often that essentially you take the number 2 in many of your markets essentially for free.
In terms of other banks, we saw Santander out. There are concerns about deposits in Spain. The shares are down with those concerns, and Brazil as well, although it seems like there are other bright spots. What's your take on Santander and the Spanish banks?
Yeah, for Santander and the Spanish banks, I think the result today, they were a little bit of a mixed bag. I personally would have expected a bit more from emerging markets like Mexico, Chile, etc., just because of this emerging market narrative that we hear almost every day. I think on the deposit flow, there is a lot of nervousness in Europe as well in America for obvious reasons. But I think also we need to differentiate what are normal deposit flow and, for example, also the attempt from banks like Santander and other large European banks to increase their fee incomes, because the net interest income is increasing, but at the same time, so they're trying to sell more money market funds, short-term asset management product. And that's eventually will beneficial for the P&L or the bank or the group.
Are we going to see higher? One thing that won't benefit them is if there's a lot of pressure, either competitive or other pressure, to increase the rates that these banks pay on savings accounts. Are we going to see banks in Europe paying out higher rates? As interest rates rise, you would expect to see that, but you know, and they'll always say it's a very competitive environment, but people don't tend to switch bank accounts very often.
No, exactly. And I think also, yes, so we'll see more pressure on that side. Then whether this competitive environment becomes a deposit war, I don't know, I'm not sure. Not at European level, maybe in some markets, for example, where in the UK, where people are more financially savvy, to put it that way, then maybe the more competitive pressure. But I think it's good we remember that actually we're starting from a very low deposit beta system level. And also we still have all these large savings from COVID that will eventually leave the banking system. Well, actually won't leave the banking system. It will reappear into a form of money market funds, of asset management products.
Okay, Filippo, thank you very much. Thanks for your time. Filippo Alloatti of Federated Hermes. Coming up on the programme, after years of big losses, Wall Street is about to make big money on US shale. We'll be discussing that in today's Big Take story. Javier Blas joins us. This is Bloomberg. Welcome back now. Shale fracking changed the world, but after years of losses, investors are looking to make a profit. Joining us now to discuss the latest big take story, Bloomberg's Javier Blas. Javier, great story, all about oil, all about the shale part of the oil universe in the United States. And this time around, you're seeing that investors are asking for profits, not just high volumes. What's the gist of the story?
Well, 10 years ago, 15 years ago, when the shale revolution started in the United States, growth was what the industry wanted, and growth was what Wall Street wanted. That led to significant losses. Investors who poured $1 15 years ago probably have recovered 50 cents on that dollar. Over the last 2 years, the whole story of the shale revolution has changed, and now is to maximize profits, dividends, buybacks, and that is coming at the cost of growth. Gone are the days where shale was growing at almost 2 million barrels a day. Now it's half of that rate, despite much higher prices.
Okay, Matt.
So are they making more money now, and are they going to be able to switch back to growth in the future?
I think that certainly they are making more money now. Shale has become a very profitable industry for Wall Street. The dividends are there. The buybacks are also there. Can the industry switch back to growth? No, I think that this is the new normal. I think that the wild animal that once was the shale revolution in the United States has been tamed. It doesn't mean that it's over, but we can see the beginning of the end of the shale revolution, of the shale boom, and certainly we can see coming in the horizon peak production for the United States.
And maybe consumers have to get used to higher prices, Javier. Is that the upshot?
It is really the upshot. For consumers, shale was great news. It kept prices lower, gasoline prices lower. Consumers now need to expect much higher prices in the future.
Javier, thank you so much for joining us. Javier Blas with the latest on that Big Take story. NI Big Take is the function to use on the Bloomberg terminal. Also available, of course, on the Bloomberg website. That is it for Early Edition. Surveillance is ahead with Tom, John and Lisa. They'll be talking to Paul Jacobson, the CFO of General Motors. Other guests also joining the team. They will also get you geared up for the earnings season from the tech space. We heard a little bit about the opportunities or not there from BlackRock earlier on, but that's going to be a focus in terms of the earnings story, as well as those numbers from Pepsi. This is Bloomberg.